Right, good morning, everybody. Let's get going. Our guest this week is Phil Waller from JP Morgan Global Core Real Assets. But before we get to him, I've got some news to run through. As it says on the screen there, if you've got questions, please put them into the chat function in YouTube now, please. That's the new way this works. So three little things that I pulled out. One is third point investors, literacy capital, and then what's going on in the battery sector, which is sort of very much unloved. Third point investors first, then. These are all 3-year charts, and you can see that their performance really tailed off over most of 23, and it's making sort of little bit of resurgence now, but that hasn't been anywhere near enough to do anything about the discount, which is still way too wide. So it's about 18% now on a fund with a market cap of about 550 million. So because of all the shenanigans that happened before, and we'll talk about that slightly in a minute, there were some discount triggered tender offer in place. So the latest one is for up to 25% of the fund to be redeemed at a 2% discount to the NAV, less costs. And the manager and the shareholders associated with him have already said that they're going to tender their share of stock. So it seems pretty light to me that the whole thing will be taken up in full. So I think basically what we're saying is the fund's almost guaranteed to shrink by 25%. Redemption notices need to be in by the 8th of May. So, I mean, if you were that way inclined, there's still time to buy some shares and tender them. But obviously, we're only going to get out 25%. So if you could get in at 18 and get out 10, but it's only for a quarter of it. Now, this hedge fund, it gives you exposure to hedge funds and invests through a master fund, underlying master fund. So it's got to redeem its share of the master fund, and about 7% of that is in illiquid investments. So once it puts the redemption notice in, it's going to get 93% of that money back in cash and 7% in what they call participation notes, which are sort of a right to the exposure in the illiquids, which obviously they can't do anything about. They have to wait for that portfolio to run off before they get that turned into cash. And because of the way that the tender works, obviously they're not going to distribute those to people who tender, the fund will carry on holding them. So its proportion of what it holds that's in participation notes is going to go up to 9%. And if these tender offers carry on going, then that participation note exposure would rise as a proportion. And obviously that might become a problem by itself. There is another tender offer scheduled for 2027, and it's easier to trigger because the last one was triggered because it was trading at an average more than 10% discount. This one's triggered if it's trading at more than 7.5%. And that measurement period is for the 6 months ended 31st of March 2027. But way before we get there, it's much more likely something else is going to happen. So what they've done is they've appointed 2 new directors who are have been introduced by Dan, connections of his, and so that immediately raises sort of alarm bells about their independence. But the board's been quite careful to say that they think they are independent. These people are sort of activists, entrepreneurial type investors, interesting kind of background. I mentioned this chairman of Plain English Finance here because this is a thing that tried to launch an investment trust some years ago. I don't necessarily think this is what's going on here. I think it's unlikely. But it is interesting that they're going on the board. They are going to form a new committee comprised of those 2 and an existing director, Richard, who was he's a sort of activist director, if you like. He was put on the board of Digital 9 back in end of last year to help get that wind down across the line, and he's just coming off that now because that is also in train. He was put onto this board really because asset value investors and people that they kind of corral together were fed up with the discount on Third Point and wanted something to happen about it. So he wasn't quite their appointee, but it was sort of, that was how it came about. So the 3 of them together are going to undertake a sort of strategic review. They quite adamant they're not looking for somebody to bid for the company. I think that wouldn't really work anyway, because obviously all you've got is an exposure to the underlying hedge fund. But everything seems to be on the table. And I think it's quite a broad list of things that they've said that they're looking at. And I think it could be something really left field. So I'm quite interested to see what happens here. It might even be that they end up bidding for another fund that's on a big discount. Or just I really don't have any clue as to what might happen. But whatever does happen, shareholders are going to have to say yes or no to it. Literacy Capital has been fantastic investment since it launched. And you can see the NAV marching up there and the share price going with it, and it trades around asset values. It's a small premium now, which is great, and it's been trading sort of a premium for a long time. And there was a brief period then when it would have been worth picking some up, which I didn't do that. There we go. Because of the sort of things it invests in, there is a scenario where it could almost end up having too much cash. And they've just had a situation where an unnamed but large portfolio company has just given them back £20 million because it's refinanced its debt. And it's using the money, Literacy Capital is using the money to pay down its debt with that cash. But because they think similar things might happen in the future, and the portfolio is increasingly mature, and they might realise more substantial capital profits, because they've done that quite a lot already. They're going to put a B share scheme to shareholders to approve in the AGM. So basically, these things, I mean, you've probably seen them already, but you've got your ordinary shares, you get issued B shares alongside those things, and then the company immediately redeems them. And it's a way of handing back cash through the sort of capital gains mechanism rather than via a dividend. I mean, if you remember, we were talking about Downey Strategic last week, and Downey Strategic wanted to do a B share scheme. It got blocked, and so they're dividending money out instead, and that's a sort of, I think, less tax efficient way of doing it. So if you want to hand cash back, this is a good way of doing it. It would just getting the approval now would mean that any time they wanted to hand back cash, they could just do it without going through a rigmarole of consulting shareholders and having votes and stuff. So I think it's probably a good thing just to say yes to, and then we'll wait and see what happens and how often they use it. But again, it's another example, I think, of just how good this fund is. It's sort of big tick in the corporate governance box for me, rather than just keeping cash on hands or diluting what they do. Lastly, Gore Street Energy Storage. We've talked about these battery stuff already quite a bit, but they've just put out an announcement. So just an update I think it's worth looking into. Also, it's worth pointing out that having rallied, do you remember I had a big moan about the way this was being rated and the fact that it was being derated alongside the other battery storage things, and it didn't really make sense. Well, it's all come off again now, and it's now hitting new lows in terms of the share price, and the discounts really wide too. So 44% discount, credible 12% yield. For full disclosure, I did buy some this week. I paid a slightly higher price than this. It's still carrying on going down, and I just think this is bonkers. I'm going to explain why in a second. The worst rated thing there is obviously Grid, the Gresham House Energy Storage Fund, which is the highest exposed to existing UK battery projects. And I've ranked these by yield, by the way. So Harmony, which is also very, very much unloved, it's down there, and it's down there because it's not really paying a dividend because it hasn't got any earnings, so it can't really do that. And it doesn't look like it's going to get much in the way of earnings this year either. Gore Street is different, and it's different because it's got a lot of international exposure. So they've been doubling down on that. So they've just been investing more money into Ireland. So they've got 2 projects there. The first stage, this Portishead thing, is going to come online in October. This one's a bit further down the line, and then they've got another pre-construction thing there. These things coming online, they're important because they build them in construction phase, and there's also quite a lot of risk involved at that stage. Once they come online and are energized, then normally they can write them up in value. So you've always got sort of guaranteed NAV uplifts coming on as these things come on. And you've also got some big projects coming online in California, that's the biggest one, and in Texas. So some at the back end of this year and some into 2025. The interesting thing about this acquisition was that they did it for cash, plus they issued almost 10 million shares at asset value, and the vendor of these things was happy to take those. I think there's just another tick in the box to say that real people in the real world do believe in the asset value. It's just a shame investors don't. And I understand why people are nervous. It's because of this whole business that grids are experiencing, and they're not really getting the revenue through the balancing mechanism in the UK. Because if you remember, there was issues with the National Grid software, and that's been preventing battery storage things from participating. They've sorted that out a bit, but although they are being used more, the revenues that they're getting are not that high, and so basically they're not seeing a material increase in daily revenues from the UK assets that they got, the GB assets that they got. And that's clearly really bad news if you're an investor in Gresham House or Harmony, because it was just knocking it down the road again before you're going to see some uplift in the income. There's also bad news because there's another new balancing contract that they thought was going to be quite lucrative, and turns out no, that's not happening, because I didn't even think there was much in the way of coal stuff left, but apparently they're being able to participate in this too. So GB battery storage revenues are depressed and are going to stay that way. I can think for the rest of this year, and you probably won't see much change until early next year, and then it will kind of ramp up from there if it all plays out the way that Gresham House people think. But, and this is the important thing about Gore Street, is that it's got all this overseas stuff already in Germany and Texas, and building this stuff in California. And they are making out like bandits because there's huge volatility in the prices. In Texas, there were some outages of plants anyway, and then they've got a lot of wind in Texas, and so if wind doesn't blow, that obviously means that prices for electricity spike up, and there isn't really a proper interconnector between the Texas grid and other grids in other parts of the US. So they can't import electricity to offset that. So they got this big spike to $1,000 a megawatt on the 4th of March. And the battery storage was sending power into the grid at this sort of prices. And they're getting similar things, huge volatility in the amount of electricity being generated in Ireland because of the storms that are going through. So, yeah. I just think that this is all set quite fair. There is a holder of GSF there who's put a question in the chat, so we just look at that now. So he's saying, how much cash was issued, long shares and other shares? I think I do know the answer to that, but I haven't got it in my head, and so I will dig it out for you. Yeah, don't worry about it. So basically, that they have not done any kind of dodgy deal here. This is a sort of sensible thing, and the fact that issuing the shares at asset value means there is no dilution for you as a shareholder. Good. So that's enough from me.